It's been nearly 19 years now since I sat in a very small banquet room of a restaurant listening to Nelson Nash talk about the infinite banking concept and how to become your own banker.
Nelson Nash was the founder of the infinite banking concept, possibly best known for his book, Becoming Your Own Banker.
In the early days of infinite banking, there wasn't much information online about the concept. Today, that has changed in a big way. There's a lot of information about infinite banking online. Some of it is great information, some of it is bad information, and some of the information is just a sales tool for life insurance.
That's one thing Nelson was so emphatic about, is that infinite banking and becoming your own banker was not a life insurance policy, nor a sales tool for life insurance.
He was very emphatic about that. And one of the things that happens when so many people get their own opinions about what infinite banking or anything else is in order to figure out the truth, we have to go back to the roots. We have to go back to the source of the information. What did Nelson Nash say that infinite banking was?
Well, besides founding the infinite banking concept, Nelson Nash was just a really nice person, and we enjoyed spending time with him. We used to host him different places around the country. We wanted our clients to be able to hear him speak, and we've had him in our home many times, had dinners with him, lunches, we went for hikes.
Yes.
Tom, you've even spent time in his home with him.
Yes, and we toured Kauai in a helicopter with him and Mary, and we just spent a lot of time with Nelson because he was a good quality person. He inspired me, and we're so thankful for the way he changed our life.
You and I both spoke at his think tank, where he would bring in agents to teach about the infinite banking concept. And it was an annual gathering that I think they ended up having it twice a year, where people would come in and learn about the infinite banking concept to go back home and teach their clients.
But, just like anything, when it gets going, people take it and use it for what they want. And I know that a lot of insurance companies came to his think tanks in the later years. One insurance company even coined a sales tool called IBC, not for infinite banking concept, but for infinite benefits concept, trying to tie into his. And it's kind of sad because that's not what I understood Nelson to be talking about. This was not a sales concept. This was a way of life, he said. It was a way to overcome the fractional reserve lending that we're all tied into in the United States.
So what did Nelson Nash say infinite banking was?
He said that infinite banking was a solution for the need for finance. And he said the need for finance is very extensive because everything we purchase is financed.
Yeah, everything. And you think about all the times that people are using finance. Every time they pull out their credit card, even really every time they pull out a debit card, they're using finance. And that need for finance, it goes a lot deeper than what most people realize. They put money in a bank account, they spend it with a debit card, or they put money on a credit card and then they pay it off at the end of every month. There's a lot that's involved in that process, but there's even more that's involved in their own cost of finance.
Absolutely.
For the person themselves. Because if they spend money, they stop earning whatever they could have earned on that money.
That was a really hard concept for me to understand because, Michelle, you and I, we paid cash for everything. I mean, we paid our first house off in 5 years following the Dave Ramsey type program. It wasn't Dave Ramsey at that time, but it was that type of program. And then we paid cash for our second house. And it didn't dawn on me how much interest we were losing for paying cash for everything.
And Tom, you said it was that type of program, but probably it was really more like that type of thinking. So we were in a different mindset, just thinking that we needed to pay everything off real quick. And we really didn't understand that we needed to be saving money in a place where it was becoming an asset for us. Instead, we were just trying to get rid of liabilities. And that wasn't the right thinking. We were successful in that, but we weren't applying thinking that was going to make us more financially successful as we could have been.
You said a word there, Michelle, that's really important. We were trying to get rid of our liabilities. And Nelson Nash talked lots of times about thinking like a banker. And a liability for a banker is not the same thing as a liability to you and I. A liability for a banker is when people deposit money in their bank. And we would think of that as being an asset. Whereas when a bank loans money to somebody, that becomes their asset, because now they're going to make money off that. Whereas if we had a debt like that, we would be saying, ooh, that's a liability.
Well, it's kind of interesting that you mentioned that, because Nelson Nash was always saying that banks and insurance companies function very similarly to each other. You could take the president of one, swap them for a week, and no one would really know the difference. And just the other day, we had some people from the home office of an insurance company sitting around our dining table. We were talking, and they were talking about a company that maybe isn't doing as well, and maybe they could purchase some of their assets, which to that company is a liability, and maybe they could absorb that because they could make some more money. So there again, looking at liabilities really as an asset. And one company's, oh, it's a liability for me. Ooh, it's an asset to a company that is able to manage well.
So even though Nelson said that that the infinite banking concept and becoming your own banker wasn't a life insurance policy, it wasn't a sales tool to sell life insurance, it does use life insurance to maximally benefit from the process of banking. And when we think like a banker and put the banking concept to work, we can make money just in the ordinary sense. And I know in our first book, Prescription for Wealth, we talked about using a tin can in the backyard that you could stuff money in. And as long as when you took money out of that, if you put more money back in, you were being like a banker, because you were building more cash reserve by using the money that's in your stash or your store of wealth.
So that could be done in a tin can. It could be done under a mattress. Some people do it with their savings account, not much different than the tin can or mattress. But when we can find a place where we can save it and it's earning guaranteed growth, that is a game changer. And that is what happens with infinite banking.
So let's look at some numbers here. Let's say that we need to buy something for $10,000. We can dip into our savings. Or if we don't have savings, then we're going to either have to use someone else's money, borrow it, or we're going to have to save it up. And you and I, Michelle, we used to save it up.
We would go without that $10,000 item while we were busy saving it up. And that $10,000 item might have increased, the cost might have increased. So we might have been having to save just a little bit longer than we initially thought.
That's right. And so now we've got, well, how much time is it going to take us? And what's the interest rate that we're going to earn on what we're putting away before we reach that 10,000 limit? And then when we get to that point, you and I would just spend it, and now we were earning nothing. We had the item we wanted, but we didn't have any growth on the money that we'd saved. And if we look at $10,000 that's earning 3% over 10 years, that means we threw away about $3,439. Because that's the interest that we would have earned on that $10,000 over 10 years.
There's always going to be a cost to finance like that, because whenever you spend money, there's always going to be something that's lost. But the infinite banking concept can help us recover part of that when we do it in balance with everything else that we're doing financially.
It certainly can. Let's talk about then, what if we would have kept our savings? And this is the concept that Nelson really made clear to me. What if we had a place that we could have kept our $10,000, leveraged it and used it, and borrowed someone else's money? And doing that, even if we had to pay a higher interest rate than the 3% that we were earning on our own money, and let's just look at 5% over 10 years. If we borrowed $10,000 at 5% and we paid it back over 10 years, we would end up paying about $1,249 a year. At the end of 10 years, we've paid $12,490 some dollars.
You didn't end up paying as much interest as you earned if you could have kept your money at 3%.
We actually made over $400. We would have made over $400 by keeping our savings growing at 3% and paying 5% interest on a loan. And the reason for that is, one is compounding in our favor, because every time we make a payment on a loan, we're not paying 5% on the whole $10,000 anymore. We've paid some of the principal off. Whereas when our savings account, every time we earn that 3%, it added to the balance. And now the next time we were earning 3% on more than $10,000.
I remember the first time we realized that. We were kind of dumbfounded that here all this time we thought we were being smart by not paying interest to someone else. We didn't realize what we were losing by just using our own money and not borrowing someone else's. And Tom gives a great example of this in his book, Prescription for Wealth. Chapter 4, he gives an example. You can go to McFieInsurance.com. You can get a free download of this book, ebook, or audiobook, or you can also purchase a physical copy from the store. That's McFieInsurance.com, and that is Prescription for Wealth.
When we get back from the break, we're going to talk about how the infinite banking concept helps us to recover the cost of finance.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted process of buying a policy to borrow from the policy so you can pay interest on your own money and still come out ahead? Could it be that some people selling infinite banking policies have made it seem exclusive just for the wealthy or financially savvy? Could it be that insurance terms such as modified endowment contract, 7-pay test, direct recognition, overfunding, and paid-up additions are hard to understand? We think the answer to all of these questions is yes. Infinite banking, as most people know it today, is too complicated and confusing. But it didn't used to be. That's why we've put together a binder called Infinite Banking Made Simple. It's just the essentials, no mind-bending magic or number gymnastics. Included in the binder are answers to the top commonly asked questions, like what is infinite banking, how does it work, and how much does it cost to start? We've made the binder available to you as a free digital download. Click the button to get your copy of the Infinite Banking Made Simple binder. You can also get a copy of this binder at McFieInsurance.com.
Well, we've explored how you can use banking with a savings account, but that wasn't what Nelson was all about, because he realized there was a much more powerful way that would benefit us more if we used it rather than traditional savings. And now we're talking about something that John Wanamaker, the great businessman of the early 1900s, he was our post officer. If it wasn't for his philanthropy, the YMCA probably wouldn't exist today because he gave so much money to it. He was the first person to bring in employees and allow them to sign up for life insurance and health insurance in his business. And his business was a department store. In fact, it was the very first department store that ever existed in the United States, where people could see what the price was in an advertisement before they went into the store instead of having to go into barter. And he eventually bought the train station in downtown Philadelphia and turned it into a huge store. And his business eventually became the May Company, which has department stores all over the place. We know them as Macy's today. So John Wanamaker understood that life insurance took better than average care of your money. And it gave you the right to leverage that money while it kept growing. And this is what Nelson Nash tapped into in a very difficult time in his life, where he was caught owing 23% interest on raw land for about $500,000. And his brother just dropped dead of a heart attack, and his grandbaby had just been born with cancer. And he said, man, what is going on in my life? How can I get out of this? And he said, it all of a sudden came to him like a baseball bat across the forehead. I can get money between 6 and 8% from the life insurance policies my brother sold me 20 some years ago. That was when the infinite banking concept was born. And so Nelson said, the infinite banking isn't a life insurance policy because, like we said before the break, we can do it with a savings account and just borrow the bank's money and keep our savings growing. But when we use the life insurance policy and we build the cash reserve up, just like you and I, Michelle, used to have to build up our cash reserves to make our purchase, then we can leverage that cash value and we can go out and make our purchase And then if we're honest with ourselves, and Nelson used to say, if you're an honest banker and pay yourself back, just like you would have paid a bank loan or a loan you borrowed from someone else, you will come out way ahead. And in an example that we just recently did, you can pay that same $12.95 a month for 10 years on a $10,000 loan and end up with almost $80,000 more than what you paid for it. That means you got what you bought, you got your money back, and you have $80,000 almost to show for it.
How does that work?
It's because the insurance company uses your policy as collateral, and they give you a personal loan out of their own, general fund. And so your policy keeps growing better than average, just like John Wanamaker and Nelson told us. And while we are using the insurance company's money, and then because we're mutual owners with the insurance company, they share the profits of the interest they're earning off us when we pay the loan, plus the profits of what they're investing everyone else's premiums in. And so that builds, and we get the best of both worlds.
It's kind of like being in another business.
It is.
You have the business wherever you earn your income, and you have the banking business, really, only you're piggybacking on what the life insurance company has already established.
In fact, you're almost verbatimly saying what Nelson Nash used to say, and I don't know if you remember this,
Yes,
John.
I do.
That everybody should be in two businesses, the one that makes their money and the banking business.
Yeah. So when we start a new policy, it's not that we get that 78,000 number that you mentioned overnight.
No.
It takes some time to build that up so that we do get that once we do a financing project down the road.
Yeah, and it's important to say that we're just paying the loan back on that example. We're not paying premiums on that policy anymore. So it's not dependent on our premiums generating that extra $80,000. It's the fact that we're repaying the loan. And the policy is growing because we funded it, just like we have to fund anything else that we
Because
purchase.
you had already paid premiums.
Right.
Yeah.
We're either going to fund it by saving up, like we used to do, Michelle, or we're going to fund it by paying a bank something and paying them off. Why not just take a little time, fund a policy, borrow against it, and pay it back, and we have the best of both worlds.
So when we speak really practically about this, it reminds me of someone I was talking to on the phone the other day, one of our clients. He has policies on his life, his wife's life. He's purchased policies on his children. And then when his children turn like 17, half 18, he has them get on a call with our office and they learn about infinite banking. And he was just telling me the other day, one of his sons borrowed money to purchase his car, and they set him up with some monthly loan repayments. And he was talking to his dad the other day, and he's about halfway through with his loan repayments. And he was looking at his policy and boasting to his dad, "Dad, I have about $4,000 available to me in that policy."
Oh, that's wonderful.
Yeah. And his dad was like, yeah. But when you realize, hey, you're buying a car, and then you're making those payments and it's showing up in your control, that you have all the payments that you've made right there accessible to you, and even more because the policy's been growing during that time. It's kind of amazing.
I remember a Sunday morning where a doctor just north of Seattle was in our home when Nelson Nash was speaking, and Mr. Nash joined us, and we sang some hymns together, and then we started talking about banking. And it wasn't shortly after that this doctor had a catastrophe happen. He had been remodeling his office. Everything had been done inside, and the contractors had not put the roof on yet. Well, that's a no-no in the Northwest because it rains, and it rains a lot. And the rains came, and it destroyed every bit of his remodel.
Ouch.
Destroyed the drywall, destroyed all the electric components, all the Cat
carpeting.
6, all the carpeting, all the equipment. He was without a place to practice. And without his life insurance cash values, he would have been completely dependent on anybody giving him a bank loan. And, banks only loan money when you have the ability to pay it off. And without an office, he was in a tight bond. But
Yeah. And, obviously the contractor was at fault there, and there's going to be an insurance a settlement there. But in the meantime, what does he do? I mean, he can't work in his office, and how is he going to produce an income to support his family?
And in this case, it wasn't just the contractor, it was the county and the city were all fighting on who was responsible, because the city and the county had allowed this building to go knowing that it was vulnerable to a rainstorm, and who was signing off on what and how, and it was a big legal mess. And so fortunately, he had his cash values.
And he could be his own banker. He could loan himself the money. And he also knew that there would be a settlement coming in where he could be paying back that money.
Something we often hear when people have seen information online, or they see the numbers for the infinite banking process, and they say, well, that looks really good. That seems like a good investment. What's the rate of return I'm going to get?
They're thinking that buying a policy is the investment,
Right,
rather than realizing that by utilizing the infinite banking concept, they, the banker, are making the investment when they loan the money to themselves to purchase a car, or they loan themselves money to start a business or make an investment. So they get confused about where the investment component lies, and
Yes.
they think it's the policy itself.
And it's easy to do because you put contributions into an investment account and you want to know what's the return you're getting. You put premiums into the life insurance policy. It's easy to say, well, what type of return am I getting on just the fact that I'm paying premiums? But Nelson Nash said that the infinite banking concept is not an investment.
It's not an investment. It's a way of managing money like a banker, so that you become more profitable. In fact, as a pilot, Nelson taught this lesson that it's a tailwind to everything else you're doing in financially. So if you have a tailwind in an airplane, you're going to get where you're going faster at a faster ground speed, and you're going to take less fuel to get there. And in the financial world, if you get there faster and have less fuel expenses, you're ahead of the game.
Yeah, because most people, they have a headwind. They're paying interest.
That's
Other
correct.
people.
Or they're
Or
losing
losing.
interest on their savings.
Yeah.
Yeah. One of the very first clients that we ever tried to help, or prospects, I should say, because they never became a client, wanted me to map out what it would look like in 10 years if you bought a policy and invested the cash value. And I worked on that for weeks.
I was going to say, you naively worked on that for weeks because
I thought I could do it. And you can't, because there's too many varying factors. That's why it's called infinite. I mean, we don't know what's going to happen tomorrow. We don't know what's going to happen next year. We don't know what opportunities are going to come up. All we can look at is the guaranteed values of the insurance company. And we can say, oh, that's going to be there for me if I pay that premium. And whether I borrow against it or whether I not, that guarantee is still there growing for me. And it's still going to earn dividends when the insurance company declares a dividend. And if I pay it back, it restores my ability to use it again.
Now, sometimes we do projections. We'll take values from the insurance illustration. We'll look at financing a specific example. We've done a lot of things to help our clients get out of debt. If they have debt that comes up when they have a policy, or sometimes before they have a policy, they've heard about infinite banking. They say, well, I'd really like to get started with infinite banking, but shouldn't I pay off this debt first? We can look at the numbers and see, does it make sense what size of policy does it make sense to start right now while you're paying off your debt? We don't want to make it take too much longer to pay off the debt, maybe a few months longer. But then if they can have a policy that's already 5 years old by the time they're done paying off their debt, now that's a big advantage to them in the long game.
And when we're using life insurance, which is the ideal product to use, we also have the human factor, age. Time is ticking. And
Yes.
so getting started now, you're going to get more value for your premium dollars. You're going to get more financial value throughout your life.
And it's not just a race to zero, because so many people, they get rushed to get out of debt, and then it's almost a letdown. They're back at zero. Now they have an asset to show for it. So we do numbers examples around that, but you're right. You can't put everything that's going to happen in life onto a spreadsheet. And if you try to and say, okay, this is the number that I'm going to have, that doesn't work in any type of financial projections, not even financial projections that deal with investments.
And with an investment, there's always a risk component involved in it. That's the definition of an investment. It may work, it may not. It might do really great, it might do mediocre, or it might lose you money. The cool thing is about the life insurance policy and storing your warehouse of wealth, as Nelson Nash talked about in his second book, you have a guarantee that if you pay that premium, a contract says that cash value is going to be there for you in whatever year you look down and see. It could be better than that, but it can never be worse. Mm-hmm. And so when we look at that, the best investment that people can make is to leverage their cash values, take a policy loan, and invest in themselves in what they do best, because we're all spending money someplace, and every dollar that we spend, we're losing interest on.
We have helped clients that have paid off debt. We have helped clients that have started businesses. We've helped clients that had existing businesses that they needed to finance upgrades or new equipment for. We've helped clients that are investing in real estate, doing all sorts of things with their cash value. We've helped clients that have just paid the premiums on their life insurance policies because they want that source of liquidity. They're in the cash values, and they don't necessarily touch it that often, but that source of liquidity is beneficial for the other things, to counterbalance the other things that they're doing. That's all different ways to practice infinite banking, and no two people, their infinite banking systems are not going to look identical because they use them for different things.
Yeah, a lot of people will build cash value up in a life insurance policy just for a reserve in retirement, because when their investments that they're depending on for their retirement income have a down market, and they don't want to pull from that and lose the percentage that they can take to live on, so they'll pull from their life insurance policy during that time. It's a great cash cushion.
Absolutely.
Infinite banking is a process of money management, not an investment. It helps you recover the cost of finance and helps you to keep more of the money that you make.
While infinite banking is a process and not a product, Nelson Nash taught us that owning participating whole life insurance makes the infinite banking process more profitable.
There are very few combinations in the financial world that allow you to access your money while it continues growing on such favorable terms. That's why we love using participating whole life insurance with the infinite banking process. Come back next week. We're going to be talking about how to grow and protect your wealth right here on Wealth Talks.